Indian mutual fund industry indeed is on a dream run, with they pumping in close to more than already $12.5 billion into the equity markets this fiscal, beating their peers, that is the financial institutional investors. Is this trend sustainable, and have they finally managed to get their act together to ensure that they are able to channelize the household savings into the equity markets? To discuss all that and much more, we have one of the most recognized faces from the mutual fund sector and a senior veteran, Mr. Leo Puri, Managing Director of UTI AMC, India's oldest fund house. Mr. Puri, as always, thanks for sparing this time and speaking to ET Now. And firstly, congratulations for your new avatar being appointed as the chairman of AMFI.
Thank you.
The industry representative body. Mr. Puri, if I could begin by asking you, clearly FY 16 is turning out to be a dream run for the sector as a whole.
Yes, it's been a very good year. So far, calendar year growth is over 25%, and equity is more or less consistent with that, more than 4 lakh crores today. So that's a very good sign of confidence in a way that households have shown in the equity markets. Some of it is the carryover of the conviction that the political reform process might still be on track. Even though corporates are questioning it, households appear to be endorsing that view for the moment. Some of that is to do with the fact that there's a little more maturity, I hope, amongst Indian investors, in that we've seen fewer redemptions. As you know, growth is a function both of inflows and redemptions, and in previous cycles we saw very rapid redemptions in the face of volatility. Despite volatility, we have seen investors staying invested, and we're very heartened by that.
Mr. Puri, where do you think things have been different this time? Things have been done differently by the industry vis-a-vis the earlier experiences, and what needs to be done to ensure that this is a sustained run, particularly when it comes to channelizing the household funds into the equities?
Well, I of course like to believe that the industry has certainly played its role. First and foremost is performance. If you look back over the last 2 or 3 years, performance is essentially the distinguishing factor of the industry, and that too the industry has generated very healthy alpha over and above the way the benchmarks have been performing. So our products have been performing very well. This has also been true of debt products, which have typically given a premium over fixed deposits. And of course, those who are invested ahead of the rate cut have benefited from a capital gain as well. And this has seen growth despite the tax, if you like, structures being changed adversely against debt products. The second thing which I think has helped is much more transparency, disclosure, and I think the right balance between firm regulation, which is oriented towards development of the industry, and investor protection. I think that balance is being quite well struck at the moment, and that builds confidence on the part of investors, and we support that process. The third thing I'd again like to believe is the investments made in investor servicing, digitization, whether it's NSE, BSE, mutual fund utility, the initiatives taken by fund houses in terms of new apps, new online facilities, hopefully some amount of eKYC coming in, simplification of procedures. These have made it more convenient for investors as well.
Okay. Mr. Puri, if you could just throw some light, if you look at the numbers, on an average $950 million per month is what we see the mutual funds have pumped in this fiscal or last 6 to 8 months. On one hand, that is the figure that is coming out. On the second, at the same time, there's an equal amount of negative news that have also come in, particularly what is happening at the global markets, the commodity market, the way rupee is behaving. What would be your advice to an average investor when it comes to Indian markets, because volatility is also been a norm for some time again when it comes to Indian markets? How do you see this Indian market doing, say, 2 to 3 years from now? And secondly, what would be your, if an average investor is investing into Indian market, that is what the numbers are showing clearly, what he should do?
Well, investing, as you know, is always a relative game, and certainly our view is that if you look at relative to a risk-free investment, whether a government bond or indeed a fixed deposit in a public sector bank, sovereign institution, you are likely to see anything upwards of 5% alpha being generated comfortably by the equity markets. History would suggest that, and I think that's unlikely to change. So in terms of asset allocation, equities in particular remains a very important place for Indian households to make sure they participate. The other thing that has happened is the relative attractiveness of gold and real estate, as you are aware, has also gone down. Gold has lost its shine, and in many cities in India today, real estate has had its own share of challenges, and I think that will continue for a while. So you are seeing, in a way, some monetization of assets happening, and that's a healthy thing. That's one of the reasons why we are seeing continued flows over and above the general level of confidence. The fact that this is happening even as the rest of the world is nervous, jumpy, foreign investors are by and large shunning emerging markets, although touch wood, not yet India for now, is even more heartening because it shows a certain amount of resilience on the part of Indian markets, which we have not seen before.
Okay. Mr. Puri, if I could ask you, in terms of sectors, do you think the other argument that is also coming around is the mutual fund industry as a whole is only looking at specific sectors, and this is not a diversified buying that is happening in the markets at this point of time?
No, I think if you look at us as an industry, you see a range of views. There are some fund managers and houses who may, for example, tend to favor cyclicals as being somewhat beaten up and therefore being good buys from a value perspective in terms of being beaten up. There are others who are more growth oriented who will continue to look at, let's say, IT, pharma, consumer goods, auto sectors where you have very, very high quality companies with very good governance who may be quite highly priced but who are still clearly growth stocks that you would want to have for the longer term. So I don't think there is a herd-like mentality across the industry. I think there's enough room for different styles, and therefore you do see a different approach to portfolio allocation, both within and certainly across fund houses, which is the right thing because it creates more choice for investors.
Mr. Puri, as you're rightly mentioning in the beginning, how the political reform process indeed has kicked off. Now the worry also is with the Bihar setback. We all know how the monsoon session was a washout for various political reasons. Do you think that may tone down the political process, or opening up of 15 sectors, particularly for the FDIs, and clear indication coming in from the government that they will stay the course when it comes to reforms, and how an important factor would be that when it comes to the performance of our markets vis-a-vis the volatility that we are witnessing?
I'm personally completely in the second camp, that I think the reaction to an event like Bihar will only be to underline the importance of Vikas, if you like, as a platform for the NDA, and that's a good thing. And I think, as you say, that was a symptomatic reaction was the FDI announcements. But there are many more fundamental initiatives underway. I think the power sector reforms, to me, again, appear to be genuinely far-reaching. I hope the states will support the center in implementing the reform of the DISCOM. Of course, it's also very good for the banks as such, but it's not just a bailout for the banks. It is more far-reaching. It will actually create a healthy power sector which has some hope of offering 24/7 electricity. So I think we need more fully thought through strategic visionary initiatives sector by sector of the kind that we are beginning to see in the power sector, and I'm singling that out because I happen to have had a recent opportunity to hear firsthand what is happening in that sector. And to me, that's a good role model, and you need to now see that replicated across other sectors of infrastructure, across financial sector, capital markets, transportation, civil aviation, and I think that's when we'll get real reforms. But I'm actually very optimistic that you will see accelerated reforms over the remaining period of this government.
Where do you see the growth rate for this fiscal? All sort of numbers have been coming in. Where would you hedge it?
I would certainly expect it to be above 7%. I know there are some who are more pessimistic, and official figures may be more optimistic, but I think something in the region of 7%, which is a very healthy growth rate indeed, is what I would expect.
Mr. Puri, before moving on to once again specific mutual fund sector questions, on the macro front, as you're rightly saying, government has taken many steps, many reform processes have been initiated, but still there are some murmurs coming in from the corporate that not enough is being done. Where do you see the last mile connectivity is not happening, or things not actually moving on the ground?
I think what has been missing in some areas is a clearly defined overarching policy framework for certain key sectors and initiatives. And that's why I was highlighting the power sector as an example, where as and when the government is able to put this together in a reasonably holistic end-to-end manner, you're seeing a reaction which is much more positive. What doesn't work very effectively and what does frustrate corporates is very piecemeal or reactive responses. That, I think, doesn't inspire the kind of confidence that will bring significant investments. We know that certainty is important. Policy certainty, by and large, is important. That includes, of course, certainty around taxation. And I think those pieces are just falling into place. I'm optimistic that we will see a much more rapid rollout of those mechanisms. And that, I think, is what will bring the Indian investors back into the market, the Indian corporates back into the market in terms of the investment cycle restarting.
Just 4 to 5 days back, the CBDT has put out the discussion paper for seeking public opinion when it comes to phasing out all the exemptions. And as we know, the FM has already declared that next 4 years he wants to have a corporate tax structure at 25%. How do you see this? Because on one hand, we have the whole push for Make in India to attract investment, but at the same time, there are corporates who say phasing out these kind of exemptions at one go would not be right. How do you see this?
Again, personally, I heartily endorse the philosophy that says that exemptions need to be phased out. In fact, the sooner the better. They simply create distortions. They are the outcome either of well-intentioned but ultimately misguided attempts on the part of policymakers to provide short-term incentives, or they're the outcome of lobbying efforts which create a different form of distortion. Neither are very healthy in the long term. And if at all used, they need to have a sunset clause attached to them. And unfortunately, we have introduced exemptions too often here without sunset clauses. So people get used to them. We become lazy, we become attached, we adapt our business models. And that's not going to create a vibrant economy. And I say this even though it may apply to us as an industry as well. I would be in favor of a clean, transparent, level playing field is much more important than a series of complex and ambiguous exemptions where you need chartered accountants, lawyers, and all kinds of other help from industry bodies to maneuver your way through. Much more important are issues like good governance, the availability of power, access to raw material, and frankly, the whole ease of doing business theme, which is the manner in which administration and governance get exercised. Exemptions are not the way to kickstart an economy, in my view.
Mr. Puri, coming back to the mutual fund sector, clearly things are hunky-dory at this point of time, but the sector clearly has got a lot of challenges in its hand. And you now being the AMFI chairman, what is going to be your roadmap or the priorities that you have set for yourself?
Well, I of course reflect the views of our members and of the industry. And the priority is to fundamentally make sure we don't lose this opportunity yet again to establish ourselves as a sustainable part of households' wallet, if you like. We've had a very good couple of years, as we discussed earlier. The credibility of the industry to that extent is getting re-established.
Mr. Puri, even now when billions of dollars are coming into the equity markets from the mutual fund sector where you are the net buyers, one would ask how much money is coming from, say, beyond the top 15 cities, because there, say, a company like UTI is where the strength lies, and you have shown that if you have your distribution right, you could get the household channels even beyond the top 15 cities. How would you look at that?
We are encouraged by the growth that we see outside top 15. And in fact, probably today you don't need to talk of top 15. You should talk of top 75 or top 100. And I think we've seen how e-commerce very quickly reached out, which is why I think, for example, the initiative that SEBI has on exploring whether we can use e-commerce platforms to reach our customers is a good one.
So distribution always has been an ongoing debate in this sector for a long time. How soon do we see the e-commerce platform being opened up when it comes to selling mutual fund products, and also when finally would the SRO see the light of the day?
On the first point, I think it's going to happen in the next few months. I think there's a fair amount of alignment, that it would be a good thing. Obviously, one needs to carefully think through how the operating processes would work, which was my point about simplified processes, eKYC, and the right product selection. Alongside that, certain issues related to appropriate remuneration, commission classes would be sorted out. But I think the industry is committed to helping this see the light of day. It would be a good thing to do. On the SRO, that is largely an issue for SEBI, between SEBI and the distributors.
Mr. Puri, if I could then ask you the regular question, what is going to be your wish list when it comes to the budget? Because I'm sure the discussions with the ministry as AMFI as a representative body has already begun.
See, our focus ultimately is on growing our industry and ensuring retail participation keeps growing. One important area there has been for us the mutual fund linked retirement plans, which is part of the pension trust that the government has. We'd like to see that being treated on a level playing field. So today we need to get separate approval for each scheme that each fund house introduces. There's no need for that. Why not essentially have SEBI automatically approve a fund or a new scheme, which is an MFLRP, and take that to market? Secondly, it would be good to have a common tax treatment. To our point on exemptions earlier, we have too many different ways of treating taxes on different types of pension products, whether offered by NPS, offered by insurance, or offered by mutual funds. A level playing field there would also actually help us, and that's an extremely important issue for us.
Coming to UTI, UTI has only grown from strength to strength under your leadership. How do you see FY16 panning out for UTI? Where do you see your AUMs?
I think it has been a good year for the industry, and I think we expect to fully participate in that growth. I think that would be our view. I think we've seen resurgence in many segments of our investor base, in our distribution base. Some of our older products, which have been landmarks in the industry, such as MasterShare, are again gaining ground, and of course many of our newer products have done extremely well. So we feel fairly confident that across both fixed income and equity, we have more than held our ground, and our brand, I think, has grown in strength and resonance.
I know you will not going to give out your strategy, but I'm sure you must have given a timeline to your team that you would want to see UTI in the top 3. Any time frame that you would like to share?
I think we are. It is clearly a medium-term aspiration for us, because we feel we have the resources that we need to be a leader in the industry, and we see ourselves as a broad-based asset manager. So unlike some of the other mutual funds, we participate actively not just in domestic mutual funds, we also participate in pensions, including NPS and EPFO and other forms of pensions within UTI. We also have a large international business, which often gets overlooked, but is very important to us and to our growth. We have had 2 very successful launches in the last couple of years of both an equity and a fixed income product, amongst the most successful launches, if not the most successful launches, by an Indian fund house of an Indian product offshore. And that, I think the flows and performance have been very good, and we do want to grow our international business. And we have a private equity alternative assets business, again, which we do within UTI. So as a broad-based fund house participating in the growth of Indian capital markets, whether domiciled in India or abroad, we absolutely see ourselves as having a leadership role in the development of capital markets, and that remains our focus. And we are, at the end of the day, India needs strong domestic financial institutions. Today, frankly, all of us are very puny. You take all of us together and we probably have less of an equity base than LIC on its own, the entire mutual fund industry put together. The size of the entire mutual fund industry is still probably a quarter that of the largest global fund managers. So we are very, very small today, and we need to raise our scale and ambition at a rapid pace, and that's what we are trying to do.
But here, if I could touch upon, meaning would ask, you being the oldest fund house, would growing inorganically be a strategy which you have to pursue more aggressively? Because we are of lately seeing a lot of acquisitions happening, particularly of foreign funds who are exiting for various reasons that is happening to their parent. Would that option is what you would look at going forward?
No, absolutely. I think there will be a continued amount of M&A, if you like, exits, entry, consolidation, and by and large, it's a healthy thing. I think those who've left had their reasons for leaving. You've also seen other funds like Invesco coming in and stepping up its participation in India. So this is not happening because people are fearful or concerned about the industry. This is happening because of specific strategies that players have. But overall, yes, I do see a trend towards more M&A and consolidation. You have to be very careful when you undertake that journey, as you know, but assuming that the right opportunities present themselves for us.
My last couple of questions on the regulatory front, Mr. Puri. We have seen certain issues being raised, particularly on the investments made in debt. You know, the company that I'm referring to, there have been a lot of debate. Do we see regulatory intervention and SEBI coming out with certain regulations when it comes to investing in debt?
So if you step back, the important point to note here is that yes, of course, there is some risk associated with debt products. What that particular incident has underlined is the importance of good quality risk management within the asset management industry. And I think it's a timely reminder. Many of us, of course, believe we have very strong risk management processes, but we need to re-examine them and once again test them against current realities. The regulator also needs to be careful not to overreact. This problem that after the horse has bolted, we are locking stable doors and suffocating the remaining horses is not a smart thing to do. Underlying this is the development of the Indian corporate bond market. That's a good thing. Exposure on the part of Indian households to corporate bonds is a good thing. So fundamentally, we must not throw the baby out with the bathwater here. We must be very careful not to overreact. And the last point I'd make is that there has been a misconception that there's a free ride on debt products in the Indian market, that somehow either the sponsors or the AMC would pick up the tab if there were to be a default. Now, all around the world, defaults occur. Nowhere in the world do sponsors or AMCs pick up the tab. So there is real risk in these products. That risk has to be managed. It cannot be essentially absorbed. And investors should also be aware that if they are getting a very high premium on a debt product, they should ask themselves, is this because they are taking more risk as opposed to simply buying the product? So I'm glad that this incident will increase awareness about both the strengths and the noteworthy points that have to be taken into account when you look at the debt industry. It's going to be a very healthy trend, but our danger is that we may overreact, and I hope we don't do that.
Okay. My last question, Mr. Puri, this is one area again which we have been discussing in all our interactions in the last 1 year. When do we see a finally REITs product coming out of any of the mutual fund house? Government is saying they have done their bit, all things are in place. What is that is not ensuring REITs is taking off?
I think some of the last mile on the taxation issues is, I agree that they have done a fair amount of work, but the proof of that pudding will be when we see developers and real estate companies actually coming forward, because ultimately we are dependent on the willingness of real estate firms looking to actually securitize their assets and start to realize liquidity from that. As of now, that hasn't, we're almost there, but that has not happened yet. I'd certainly hope that in 16-17, we may not see it in FY16, but in 16-17, we will be in a position.
Would a housing regulator also make things much more easier for REITs?
It could help. I think it could help if it were to provide a certain framework within which certain types of assets could actually be regulated. But it's not, at this point, that is not the bottleneck. I think the bottleneck has been, on the one hand, removal of the last mile issues on taxation and the perception of dual taxation, and also the willingness of some of the real estate companies to bring their best quality of assets to the table and actually put those on the block, if you like.
Puri, once again, thanks a lot for sparing this time and talking to us. Pleasure.
Thank you very much, Vijay. Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.